All right. Good morning, everybody. I had mentioned when the Fed goes into quiet mode that we needed to keep an eye out in case Janet Yellen decided to come chipping her teeth. She did once last week, and there really wasn't much said. And then again yesterday, or at some point over the weekend, she was out there chipping her teeth again and kind of gave this impression of a more dovish Powell. And she can't speak for him, and she certainly doesn't represent anything more than a cabinet member, for the current president and the current administration. But she does have the ability to move a market and to change sentiment. So we've seen a little bit of that. This week we have CPI and we have FOMC. And as I was doing some work over the weekend, I made a small video explaining the size of the risk that we're facing. Last week when we had PPI, I mentioned how it was possible that there was a third choice. We could go up really big, we could go down really big, or we could also just kind of continue to hold the range, because that third choice was a viable choice. It did exist. It doesn't exist this time. We're going to get the CPI, and then we're going to get the FOMC, and it is no longer the third option of, well, maybe we'll just kind of go sideways. It is a binary event. It's going to be up or down. Binary, like yes and no, right or wrong, left or right, up or down. There's no other choice. There's nothing else on the table. I kept those ranges marked. We'll be looking at them as we go a little deeper in today. I did also finish the write-up on the website. Always just check the date to see if it's on the current week or not. We have triple witching this week as well. If you haven't figured it out yet, we're also on the March contracts on the ES. We're not the only nation with rate hikes this week. Something to also keep in mind, that the moves in the after hours due to other nations around the world also having an FOMC of some sort. They probably don't call it the same thing, right? But changing rates. So it's going to be one heck of a week. We do have additional auctions today at 11:30 and at 1 o'clock. The 1 o'clock auction is really important to me, especially when I do 0-day trades. Don't leave yourself exposed to a big move, in the afternoon, when usually we get past, say, noon, and we start looking for an opportunity to do an afternoon 0-day play. If you don't watch the clock and you get in before 1 o'clock, and then we get the 1 o'clock econ, it can just straight up run you over. So, a lot of people that are playing the 0-day trades, they're going far out of the money using, a 10 or a 12 delta, putting on these really far away credit spreads in the anticipation that if they go far enough out, they won't get hit. And I'm trying to warn you here that if you try that on a day where we have afternoon auctions, you might not be able to get far enough away. You're very likely to just get run over anyways. So the recommendation is to wait until after 1 o'clock. Usually within a good 10 or 15 minutes, you will notice if there's going to be a reaction, you'll see it at that point. It's not usually very subtle. We do have an expectation that the market's really not going to go anywhere. FOMC are volatility suppressor events. I know that doesn't quite make sense. Volatility is up because we have a very big unknown, right? But at the same time, market movement is compressed because nobody wants to make a decision before FOMC. So when we talk volatility, this is the dichotomy that we have to deal with. These two different thought logics. Volatility on a candle chart means movement. How far did we go from one candle's close to the next? Volatility in an options chain is directly connected to volume and transaction. So it's still volatility. It's just the word difference. To a point, and I'm going to actually touch on that a little bit because here on my notes on the left sidebar, we're going to be expecting a little different reaction from CPI this time than we had last time, because this CPI is right in front of an FOMC, like literally 1 day away. So we're not going to get that vol crush that we normally would. And instead, we're going to either A, keep the volatility that we've already got, or B, we're going to ramp up even higher in volatility. But that's options implied volatility, not volatility as in candles. So when you hear somebody say that the FOMC brings volatility, they're referring to the options. When we refer to the FOMC being volatility suppressors, we're referring to volatility on a candle chart and how far we move from candle price to candle price, close to close. Volatility on a candle chart really needs a different name because it just confuses people. Close to close would be a much better name than volatility. Looking at the monthly chart, you can see how the 50 has managed to do its job. And it's very likely that if we get this soft landing that they're talking about, that we won't get another close below that 50. That's something to consider in the bigger picture. If they fail at this endeavor and actually end up causing a recession, it could bleed over into companies' ability to make profit, start whacking down, global economy, and we make it through that 50. A lot of funds out there use monthly and quarterly moving averages. And they use monthly and quarterly charts for their decision-making process. They're not trading on dailies and weeklies, but we don't want to lump all of them into one group, right? They, them, those guys, the institutions, there's a lot of different ones. They are as diverse as we are. So we can't say that they all do one thing or that they all don't do something, but a very large part of them are using the monthly, the quarterly levels and quarterly moving averages and monthly moving averages. We are primed this week for a weekly TRB. It's a trendline breakover. we have the capacity to get above 4,100. I did my work over the weekend on the SPX. And I used Tastyworks options change showing the 1 standard deviation and the 2 standard deviation measured move for December 16. And the upside moves was 40.61 and 42.25. So I didn't math these numbers. I didn't calculate anything. These were on the platform over the weekend. That was the level to the upside. And the downside levels are 38.07 and 36.45. So that is on the table this week. Now, I don't know if we're going to move that far. I'm not saying we're going to move that far. But we have the capacity to move that far, and it wouldn't even be considered extreme. It wouldn't be considered an outsized move. It would be in line with what we've measured. The way that Thinkorswim's platform works is you can turn on the Friday expiration lines. These are the 3rd Friday of the month, which is what we have this month, this week, right now. We're in OPEX week. When we do that, we can also turn on an indicator called probability of expiring cone, which is set at a 1 standard deviation. And if we zoom in a little bit, 40.64 and 38.09 is the expected move for December 16 using that tool. And it lines up really close with what Tastyworks has in their options chain. But let's look at a 2 standard deviation move instead of a 1 standard deviation move. Now, if you don't know what a 2 standard deviation math, what number to use here, which is 95, if you wanted to validate that and make sure that you weren't just blowing smoke, you could go to the Analyze tab, Risk Profile, Probability Range up at the top. It lets you pick a 2 standard deviation move, at which point it gives you your probability right there. So it's 95.45. I'm going to leave the 45 off and just go with 95. And that projects 41.99 to the upside and 36.92 to the downside. So it comes in a little shorter than what we've seen at Tastyworks, but it displays elegantly our risk this week. So please be careful. If you have trades on that are not really something you have to have, consider getting rid of them this week. Get back into them next week. I know a lot of traders feel like these events offer an opportunity to catch really big moves, but you don't want really big moves unless you've got edge. You got an idea that we're going to go up, or you got an idea we're going to go down. How could you have that idea right now when we don't know what Powell is going to say, and he is going to be what causes the move? You know, if he decides to drop this market, that's what he's going to do. Or if he doesn't care that we continue to rise, like when he spoke on November 30, he didn't do any extra work to drop the market. He didn't care that it had rose up, and he might not care now. So we don't know. We can't game that out. In the video over the weekend, I explained how this indicator really can't display the situation that we're in. It wasn't designed for this kind of situation. It was designed for normalcy, and it's doing the best that it can, but it can't get to the data that it needs to get to. Mobius, the guy who coded that thing, did the best that he could, but Thinkorswim doesn't offer you access to this data using code. So you can't get this number with an indicator. You can get it by hand, just come in and turn it on and look at it. This indicator is asking how far away from the 10-week are we, and are we above it or below it? And we're above it. We managed to come back to it, bounce off of it, and then rise back up. On the year, we've been 3.5% and 4% away from that 10-week, and right now we're only 1% away. So looking at this, we're not overbought, we're not overextended. We're pretty close to the center of the basketball court, and we have the capacity right now to make a really big move up or down because we're not on the edges of anything. Swap that over to a daily. And you can see that we're just barely back above, but we're there, right? We're sitting on the 10-day right now. The 10-day is the 50-week. I said that wrong. Either way, the 10-day is kind of a go, no-go level. So it's certainly a critical one to keep track of. Think of the 10-day as the average price, the mean. So we're either buying it at a higher price, or we're trading it at a higher price, or trading it at a discounted price. So when we're above the 10, we're paying up, and when we're below the 10, we're getting it on sale. It's a really good way to look at it. But we have the capacity also to make a really big move here. This shows that we're right in the center of the basketball court. We could make a big sweeping move in either direction. So I can't stress it enough. There is a very strong chance that we're going to make some big moves. Expect light volume Monday, Tuesday, and Wednesday. And the thing is, this is going to be a little bit of it's going to be a little bit confusing, because with OPEX, it brings in a lot of volume. So we're going to see volume, but that's roll volume. That's position management and a position adjustment, hedging. It's not directional or picking a side. So you're going to see the volume from OPEX, but we're not going to see the transactional volume from traders coming in and making decisions. Right now we're sitting at a 64. If we've seen that on a day or in a week where we didn't have this kind of expected volatility, that would be a concerning number, because we already know what's going on this week. We don't need that. We just set it aside. We are above the weekly pivot, and we have not yet touched the daily pivot. So we have an MDP. Real quickly here, I'm going to strip all this off for a second and point out this green line. This green line is Thinkorswim showing me that we had a contract change event. And there it shows a gap here. And that's because we went from using the December contracts to using the March contracts. There's not really a gap, though, especially if you're using a continuous contract platform like Thinkorswim. So what you could do is go to the setup. No, let's do that differently. Go to the gear icon, go to futures, and adjust for contract changes. When you hit apply, dun, da, 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 now price is in a different location. Technically, price is where it was before I did that, but the gap is gone. Okay, so continuous contract platform like Thinkorswim versus, Ninja or Trade of 8, Infinity Brokers, one of those other guys where you've got to tell it what contract you want. So don't let that gap fool you and make you think, oh, well, we got to go down there and close that gap. No, what gap? I didn't see no gap. So gear icon, futures, adjust for contract changes, get rid of that gap. And don't try to game it out. It's just going to hurt your head. Hurts my head just thinking about it. Now that we've done that, we are through the weekly pivot, and we have not yet hit the daily pivot, but we're working on it. Probably going to come up and hit into the other side of it. We had a very narrow IB last night, an initial balance. It was holding relatively tight, and then we got through the kill zone, and we had a little bit of a push this morning. We're inside day, sitting inside of Friday's price action, and we're expecting to have a very muted week for at least the first half, right? Definitely at least today. There should not be some big, massive run. I say should. News could come out and the market could just grab a hold of that news and run. Keep in mind what I've talked about. The Fed is in blackout mode. They won't come out and say something until FOMC, but their snitch, that Fed dude, Nick Tamaros, watch his Twitter feed, because if they want to spill something to the rest of us, they're going to run it through him. He's like their little puppet. So they could come out between now and Wednesday if some news was to happen and, put a data dump on us. We're not expecting that, right? That would be odd. It would be unusual. So we're looking at the range here, maintaining between the cog lines of 40.11 and 39.11, a 100-point range until at least tomorrow when we get CPI, and then Wednesday when we do the FOMC. At 2 o'clock Wednesday, they'll release the minutes, or the kind of not really the minutes because we get the minutes later, but they'll release the notes. They'll make a statement digitally, and then Powell will come out at 2:30 and he'll speak and answer questions and blah, blah, blah. So we don't really need to game out the AVR levels today. Likely we won't need to do it tomorrow. It's all going to come down to Powell. Friday, I was shopping around looking at options, and I was just going way out of the money in things that are usually pretty liquid anyways, Apple, SPY, the Qs, and just pricing really cheap junk, far out of the money. These are 100% scratch lottery tickets. They have a very low chance of winning, and they have a very low risk dollar value, but you choose how much money you're willing to risk and then, put the trade on. If you're wrong, it's not salvageable. It's a 100% loss. So trust me when I tell you, these are exactly like a gas station lottery ticket. You go in, you spend $5, you scratch, and if you win, great, you make a couple bucks. And if you don't, you throw the darn thing in the trash because it's worthless. You're done with it. That's it. So I picked up some S&P options in the SPX for around $1 a piece. And then some Apple spreads and some Apple puts. kind of gives some idea. Keep your focus on liquidity. It's a really big deal. Try to focus on the most, heavily traded, highest liquidity products out there, which is basically the monsters of tech. As much as we don't want to say that, but you're looking at Friday. You want to take it kind of far out of the money. And just for a little bit of a review, avoid trash, avoid bag holders. You do want to go far enough out of the money that you're not wasting your, a large chunk on a YOLO play. But on the other hand, if you go too far out of the money, you just get into trash, and then those are worthless options. So here on the put side, you can see how the curve, it's going lower and lower, right? We're going from, let's bring Mark in. We'll use the volume here and just swap it for Mark. So looking at Mark, it's like the mid price between bid and the ask. It transitions the way it's supposed to. The farther out of the money we go, the cheaper it gets. But then you got to watch, because it'll start to turn around and actually go the other direction. I think I picked a poor example here. Meta doesn't have that this morning, but one of them will. Yeah, so here on the call side, we go from 16 to 11, 8, 5, 3, 2, 1, 1, 1. Now it didn't flip. I thought I caught the flip in there. But it'll actually start picking back the other direction. And what it is somebody is trapped in an option. It's at total loss, and they're just putting a number on there and throwing it out there, hoping somebody is stupid enough to buy it from them. And somebody will come along and say, oh, I'm going to buy that thing because it's way, 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 way out of the money. It'll be the farthest away that they could get. And they're only looking at the strike and not realizing that it's just junk options, it's trash. So don't go so far out of the money that you're getting into trash. Try to keep it at least above a 5 delta. At least. And, depending on what you're trading, that might not be easy. Some of the cheap stuff out there. So on these yellow plays, if you can't find just a straight up call or just buying a put at a cost favorable enough to you, right? Because we have to be able to stomach this loss. We can't go out there and spend, $1,000 YOLO plays. But butterflies are really cheap, right? Especially when you start going out of the money on stuff. So, if you're trying to buy a call, say in Apple, and you want to add around the 150 strike, that's $50. Anybody interested in buying, $50 worth of lottery tickets? I'm not. But putting a butterfly there would very likely cost 2 or 3 pennies, maybe 5 pennies. Granted, your chance of winning, because you've now went from looking at a call to a call butterfly, your chances of winning is going to go down even more. But your loss factor is down a lot more too. Plus, you can skew the butterfly and, broken wing butterflies and all that good stuff. It's really not advised to put on an iron condor for the week. To put one on for Monday and or Monday and Tuesday, yeah, hey, no problem. No argument out of me. But don't try to put on an iron condor for the week, because you would need to make it at least this big. And you're probably very likely not going to get any premium for making it that big. But on the day, if you do an iron condor for tomorrow, put it on today, avoid PDT, that's a really good idea. Actually, it's not a bad idea at all, because we're not expecting anything until at least CPI tomorrow. right? And even that one's not expected to be too volatile if it's in line. And that's kind of the scary part, right? Because if it's not in line, it could break your iron condor. So we talked about volatility at the start of all of this. We're going to be looking for a CPI without a volatility crush if the numbers are in line. And we're going to be looking for CPI to bring even more volatility if the numbers are higher than expected. So we're not looking to see volatility go down because of CPI like we had volatility last time. Yeah, I mean, buying an iron that would expire at the end of the week, that's not a bad idea, because I really don't see that this event this week is anything other than binary. When we had PPI last week, I added the third choice and said we might not go anywhere, because that was a legitimate choice. And it turned out to be true too. We got the PPI and we kind of ran around a little bit, but at the end of the day, we really didn't go anywhere. But this week, I really don't think we have that choice. I don't think not going anywhere is on the table. So you could certainly buy an iron, what they call a gamma iron, even though it really doesn't have anything to do with gamma. You could buy the iron, and if you wanted to protect it, you would just put a butterfly right in the middle of that iron. So your iron, would look like this with your profit or your zero line. And say, price is sitting in its current spot in the middle, and you need it to go in one direction or the other. Well, in that middle is where the risk is. So if you were to also, after you load the gamma iron, if you were to also go in and add a butterfly right in the middle, you could reduce that risk quite a bit. Well, that's some scribbles for Monday morning. There is a little bit of concern about the PPI numbers, or the CPI numbers, because of the PPI numbers that we got. One of the things that really stood out was the increase in food prices year over year. It ticked up. We're up plus 14%. So food costs are front and center, and it's not expected to get any better anytime soon. So, thinking about inflation and inflationary measures, PPI came in a little hot. CPI could be a little bit of a surprise. The Fed keeps saying their target is 5.25. The market keeps pricing in around 4.5. So there's a dichotomy that's at some point that this divergence needs to be resolved. Powell might try to resolve that today. Well, we do until FOMC, right? So if you look at the options chain and the elevated volatility that we have here, it's expected to stay high until FOMC. And that there's not really an expectation of volatility crush the way that we got it CPI last time. I don't think we're going to be able to see it here. I'd probably have to go into the go back. So here's CPI last time, and there's that volatility crush that we're talking about. It was a significant change quickly, right? And that's not what we're expecting this CPI. And that's a big deal if you're the seller, right? Because when you know there's going to be a volatility crush, well, then you just go out and you sell something today and buy it back tomorrow. And even if you're wrong on the direction, you can usually get out of that wrong trade with even a little bit of profit because of the volatility crush. This time, CPI is not expected to provide that sort of volatility crush. We're either going to maintain into Wednesday to get the FOMC and then get the volatility crush, or volatility is actually going to go up after CPI as we come into FOMC. I also did a little bit of research over the weekend on how far we move in the FOMC week from one Friday to the next Friday. And for 2022, the average distance was plus 5%. So, on the Friday before FOMC to the highest or the lowest point during that week of the FOMC, the move was more than 5%. That's on the table. That we could go 5% higher or lower in the SPX. And you could translate that into Apple or Microsoft, Google, wherever you want to go by using fast beta, right? If the S&P moves 5% and you're looking at trading Tesla that's got like a fast beta of 2, then, you're looking at the very least, a 10% move in Tesla. It's really something to think about. Lock limits don't change for holiday events. So the normal lock limits that we have in play for the futures are the same as they always are. And then the same lock limits for intraday trading. And we haven't triggered lock limits on FOMC and CPI and PPI this year just because of an FOMC event. So it's very unlikely that we're going to do that, this week either. But we're talking a 5% move for the whole week, and you would need a 5% move in a day before you start getting near those kind of lock limits. So that shouldn't be a problem. So keep in mind that this week, a lot of the things that we would normally look at, pivot points and structural levels, and cup and handles, head and shoulders, all of that goes to the back burner. That is secondary to the idea that once he opens his mouth, this market could go wherever he wants to drive it, and he is driving. He will decide if he wants it to go up or down by doing a mic drop moment like he did at Jackson Hole. That was a deliberate push against the market. Or by being cagey and shady and just wishy-washy in his statement, he can make it kind of run around in a circle if that's what he wants it to do, kind of run around and go nowhere. This is why we talk about the plunge protection team having the power to come out and move the market. When I was new, I thought that meant they would come out and trade, that they would buy something or sell something and make the market move. That was totally off track. That's not what they do at all. All they got to do is come out and open their mouth. They can move the market wherever they want. So don't trust this box this week. At least don't trust it on the S&P. Do the work by hand. Come in and get your levels from here. And, consider if you don't have any trades, consider perhaps just avoiding the whole trading week. I know we all like to trade, but trying to second guess where we're going to go before FOMC is kind of a little bit of futility, right? I mean, you could do like a strangle, a straddle, you could buy the iron condor, what I call either or trades. But those could still lose because you need enough movement to actually get outside of the break zone. And we could make a big move and then just come right back inside it again too. Even though we make a big move, nobody says it has to keep the move. I made a statement in that video. Well, with editing, I don't know if the statement stuck, but I'll restate it today. I don't see that we're going to have a doji candle at the end of this week, right? Like out of all the possibilities, we don't want to say price can't do something. We want to talk about the likelihood or the probability that we're going to see something or not see something. The idea that we would see a doji candle at the end of this week is a very, very, very low probability. I don't see that that's going to happen. Technically, it's possible. And technically, we would never want to say that price can't do that, right? But it's the lowest probability outcome out of everything that we have. $10-day, 30-minute volume profile. Should we continue to grind higher today for news or for any other whatever reasons? Around the 4,000 level and into 4111 or 4011, excuse me, 4011, the cog line. We do have a volume shelf there. Past that, it's kind of clear skies until we get up into the 4080 zone. On the week, remember the level that I gave out at the start of all this, 4011 to the upside, 3911 to the downside. That's your 100-point range that we're going to expect to hold at least through today and very likely through tomorrow as well. If CPI comes in hot, I mean, we're going to break that, no doubt, but I don't think it's going to come in hot. If it comes in within expectation range, and if they don't do a revision on the other data, right, because that's their opportunity to revise data, I think we're going to hold between 4011 and 3911 until FOMC, and then, game on from there. We just got tier 1 alpha email come in. Well, I thought we did. There it is. All right. Let me put this back and actually just take this. So this is an email that comes out every day from Tier 1 Alpha. It's free. It doesn't cost you anything to sign up to get it. They have extensive data in here. Some of it sits me back, kind of scratching my head trying to figure out what they're talking about. This is very smart stuff. which is cool. I mean, I don't like getting a bunch of email where they're just telling me the same old inane stuff that I could catch on like Yahoo News kind of junk. It's just junk. I don't need it. But, you know, bright and early in the morning, getting some really complex market logic would be a little rough without some coffee. Every morning in this email, they provide 5 pivot points. So you get your SPX gamma bands with your upper band, lower band, and your 0 gamma level. And then a little bit farther down in the email, you get your probable volatility bands. So put those together, you have 5 pivot points. This picture right here is really great at explaining the volatility for CPI that I was just talking about. We're not going to expect the volatility to go down after CPI like it did last month. We're going to expect it to either go sideways and or actually go up higher into FOMC, depending on if it's in line or if it misses. After FOMC, then we're going to expect the vol structure to change. Now, speaking of those volatility bands and gamma bands, they do offer it on other products as well. So you can load up, if you were to go in and do the work, it would be a little bit of work to do too. You could go in and draw those levels out for, you know, the monsters of tech and even a couple of the indexes, Qs, IWM, SPY. So depending on the kind of trader you are or where you want to allocate your capital, got a lot of information in this email, including the gamma bands for those XL sectors. This is a part of that breadth that we've been discussing. How many stocks are above their 20-day moving average? It's an old school market indicator, old school breadth. In the orange, that's the S&P. And in the cyan, that's the number of stocks above their 20-day moving average. Or I should say that's SPY. And then, you know, not the SPX. So all the breadth out there right now is showing that the VC funds, the CTA buying, the end of the year fund manager buying, all the buying's kind of just dried up. And we've seen this drop in the total number of stocks that are doing good overall, kind of that rising boat and all, you know, lifts all boats kind of discussion. Well, all the boats are fading out. Even so, even with the breadth being negative, if Powell doesn't care that the market goes up, and if he doesn't deliberately, you know, put information out there to send us down, the chase into the end of the year to the upside is very likely going to be very dramatic. And if they give up, if they just throw up their hands and say, screw it, and they start selling into this Christmas, it's very likely going to be one heck of a sell-off, which is why it's so extreme and why our levels are so wide. But I didn't make these up, right? These came right off the broker page. So if we wanted to see what extreme would look like, we would take that measurement, cut it in half, and then add it to the current measurement, just like we do with the ADR. At which point we would actually break that 43.50 pivot point from back here, and that would be a game changer on the year. Everybody have a good week. Be careful, be safe, and I will see you all tomorrow.